One common mistake that I see a lot of traders and investors in the stock market make is they try to be smart. They try to use common sense. And in this video, I'm going to show you why that's a bad idea if you are a trader. Now, maybe not if you are a long-term investor. Buying great companies for the very long term makes a lot of sense. But in the short term, applying common sense is a way to miss out on great opportunities and take bad trades. Let's jump into the slides and I'll show you what I mean. So we should never trade with common sense. As I said, many investors and traders miss out on great opportunities because they use common sense. At the same time, many investors and traders take losing trades because they use common sense. And I'm going to show you two examples, one Nvidia and another one with the symbol OCTO, which you probably haven't heard of unless you were watching the market today, because it was a huge gainer that made absolutely no sense. It's important to not trust your judgment. Instead, trust the message of the market. Do what the market tells you to do. And in this video, I will teach you some simple principles that work the best. We're going to look at the concept of optimism versus pessimism, understanding why abnormal activity is so important, and why price volatility will give you a lot of clues to where a stock is going to go. Now, as I said, we're going to look at the chart of Nvidia first. If you've been following Nvidia for the last little while, you will know that about 2 weeks ago, they announced earnings. Their earnings were great, better than expected, huge growth, all of the things that make Nvidia a great long-term company. But for the trader who bought on the news, who bought because earnings were good, which would make a lot of sense, they have suffered losses because Nvidia has gone down since then. Let's look at the chart and we'll start to emphasize some of these concepts. So you can see that Nvidia announced earnings right there at around $182 a share, and it's now at 170. Not a huge loss, but still a loss. Now let's think about some of these concepts. When there are rising bottoms on the chart, like you have here, there is optimism. When there's falling tops on the chart, there is pessimism. When the line that you draw across the bottoms, which is our trend line, is broken, that shows that the buyers are losing control and the sellers are taking over control. And you can see that that happened about a week before the earnings came out. In other words, the big money investors in the market started selling the stock aggressively before the news, before the earnings came out. And again, not that the earnings were bad, they were very good, but the stock had made considerable gains over the number of months before the earnings came out. And as a result, people just wanted to take profit. And that started before those earnings came out. So if you were using common sense, you read the news, the earnings are great, you watch CNBC or read the Wall Street Journal, earnings for Nvidia are great, you think it's got to be a buy. But that was based on the past, and the market started to predict that many months before, because if you've been following Nvidia, the stock has had a great run over the last 2 or 3 months. And this is an important concept to understand. The stock market does not react to the past, it predicts the future. And so when you look at a stock announcing news, that news has often already been priced in by the market. The market prices these things in long before, and when the news is made public, for many investors who are anticipating the good news, there's no longer a reason to own it. And that's why you often see stocks sell off after good news. Now, let's take a look at this chart of OCTO, which was a huge gainer today, OCTO Holdings. Now this stock started behaving abnormally in the pre-market. This is 4:30 or 4 o'clock a.m. Eastern time. And at 4 o'clock a.m. Eastern time, the stock made an abnormal price jump on abnormally strong volume. Now, why does that happen? Well, it happens because the people that know the most about this company started buying it aggressively as soon as the pre-market session opened. Now, I don't like to buy that initial break because it can often be a fake out. What I like to do is buy the pullback and then the break of the pullback. So if we go back to the chart, you'll see this little blue dot right here. That blue dot is a crossover. So the stock pulled below its moving average and then crossed above it. And I made an indicator to look for that. The second signal is this right here. This is what I call my action candle indicator. It's my own concoction. I've been using it for 20 years. It's something available to the members of Stockscores.com. If you want to learn more about that, you can go to my website, Stockscores.com. What's important is that we had this pullback and a break of a pullback, and the stock started to move up. Now that was just before 7 o'clock Eastern time in the pre-market. Now OCTO gave a number of buy signals today using this methodology, but let's drive home the important points. We have an abnormal price break, abnormal activity, from optimism, because we have a rising bottom, from low volatility, because the stock was trading sideways. So anytime you get a abnormal break from low volatility where there is optimism, there is often going to be a strong move to the upside. Now, if you were using common sense, you would say, well, the stock's at $4. It started the pre-market session at $2. It's already up 100%. It makes no sense that it can continue higher. And yet, you know what? OCTO today moved up over 1,200%. I think in intraday it was even more than that. If we go to the next slide here, you can see exactly what happened. That initial break that I showed is this right here, just before 7 o'clock at around $4 a share. Look at where it went, $83. Does that make sense? Absolutely not. If you were applying common sense, you would never have touched this stock. If you were simply listening to the message of the market, following simple concepts like abnormal activity from low volatility from optimism, you would have jumped on this stock a number of times. There was a number of situations where the stock made those breaks from low volatility price patterns. So if you want to do well in the market, and I'm not talking about the long-term buy and hold investor, but rather the shorter term trader, you could be in and out in months, you could be in and out in hours, you could be in and out in days. That's trading. And when you're trading, do not apply common sense, because if you do, you're going to miss out on great opportunities like OCTO, and you might get suckered into buying a great company where it's not likely to go higher, like Nvidia. Hope you've enjoyed this video. Make sure you check out my website, Stockscores.com. There is a free weekly email newsletter on the homepage that you can register for. I pick stocks in there. They've done great over the past, and so something to take a look at there. If you're not subscribed to the YouTube channel here, make sure you do that. And as always, trade well.